Hi, this is Dan Genter, President and CEO of RNC Genter, and I just wanted to take a few minutes and just bring you up to date with regards to the current situation in the market from our viewpoint. First, yesterday actually was the 1 month anniversary of the absolute low in the market, and it was actually very close to the 2 month anniversary from the high of the market. So right now we're up 23% off of the low, and the overall pricing action that you've seen in the market, stock market, despite the tremendous volatility, has really not been unusual if we took the timeline out of the chart. In other words, what's been unusual about this market is not the amount that it dropped, predicated upon a major surprise, a significant unknown, a tremendous amount of earnings uncertainty. Normally when the market goes into that, a situation like that, it's very, very typical. We go in 10 to 15% overvalued. People are looking at very positive earnings momentum, positive economic growth, and then there's a shock. Something occurs. It's a financial crisis. It's a health pandemic, obviously in this case, but there's a shock. There's an unknown. So the first thing the market does is it gives back to 10 or 15% where it's overvalued. It typically then gives back another 10 to 15%. There's 30. And in many cases, it'll give back whatever you gained in the prior 12-month period, which in this case, obviously, the market was very robust and very positive during that period. So for us to see a 30, even 40% drop from the high was not unusual. And that's what we saw. We basically saw a 30% drop. We gave back to 10 or 15% overvaluation. We went to 10 to 15% undervalued. And then we had a capitulation, if you will, at least one in the current time period, but we actually went down 37% intraday on March 23rd, and then backed up and closed down about 34%. So what happened, if we again took the calendar out, was very, very normal with regards to the contraction, a capitulation, coming back to 10-15% undervaluation, then back up to a more reasonable valuation where we are now, 23% off the bottom. And basically, as we've seen in the last several days, kind of fluctuating back and forth. We're up or down a few percent. We're flat. It's basically hovering in this range of somewhere down 20 to 25% from where it originally was at its high 2 months ago. So again, that part's not unusual. It was just a compression of the time frame that it literally happened in a matter of weeks instead of happening in a matter of months. So the real question now is, that's what's happened, what does the future hold for us? And obviously the unknown continues to be there, because the overall market gets driven by one very specific thing, and it's get driven by earnings. And that hasn't changed for 300 years of history in the American stock market, and it's not going to change in the next 300 years. You're buying companies, you're buying their future earnings growth, and your prospect for that future earnings growth. It's actually not that complicated. So right now we're at, for all practical purposes, based upon the current outlook, looking at the next 12 months, if you're estimating somewhere about $170 in earnings on average for the S&P, we're trading at 16.5 PE based upon 2021 prospects, and so we're pretty fairly valued for what the current outlook is. Now, what's going to happen will be perception of that, obviously, and then it'll be what changes. If we get back to work, sometime in June or July, then we're likely to see those numbers. If we don't, or the pandemic expands or reoccurs, things will have to get adjusted for that. So right now, we're most likely in a consolidation period in the absence of new news that's going to drive it strongly one way or the other. But shifting and really looking at the bond market, for example, that's frankly where the real unexpected turn of events occurred. As I mentioned, the stock market, though compressed in time frame, was fairly typical. I mean, we would look back at that and say it pretty well did what it did during the last 5 bear markets. But the bond market was another item altogether. Is that what we had is a pandemic of its own in the fixed income market, which was really a crisis of liquidity. And so having done this for 40 years now, and with very senior 20, 30-year plus portfolio managers that I have on staff, no one had ever seen that type of crisis in liquidity. And two of the major things that caused it was there was clearly a run on the bank and a run for the fire exits, with people hitting the sell button of sell everything in ETFs and mutual funds, And we unfortunately saw the risk of people that are in those types of commingled investments, that if people just decide they're selling everything, then the baby goes out with the bathwater. They sell bonds, they sell stocks, they sell corporate bonds, muni bonds, they sell treasuries, they sell everything. And so portfolio managers basically trying to save their NAV were forced to sell. They were actually forced to sell, trying to sell to preserve the value, short-term high-quality investments. They sold a lot of treasuries, they sold short-term munis, and so you actually ended up with a crazy inversion that where you could actually sell, you had shorter-term, higher-quality things that were actually yielding higher than longer-term issues. And you really had a shutdown on the market, and it was caused by that just flood of people selling for no valid or logical reason. And then you also had a situation to where people often forget that in the bond market, unlike the stock market, people are taking, there's a counterparty that's taking that into inventory. Now, normally that's the large brokerage firms, it's the banks, and because of the new regulations with regards to ratios and risk assets that the banks have coming out of the 2008-2009 financial crisis, and based upon the TARP requirements that were put on them, they hit those limits. And so when you looked at the major market makers, again, banks, brokerage firms, they hit a limit where they could not take any more risk assets on their balance sheets. And so, and unfortunately, even treasuries, as you might not expect, are considered a risk asset. So they reached a point where they just could not buy anymore. So the market went to trading by appointment, which meant they were only willing to take it into inventory for, in some cases, a few seconds or a few minutes at most, where they had a counterparty, a buyer on the other side if you were trying to sell, and it literally just went in and out, and they had no risk of closing their books that evening with that on their books. And that actually occurred for about 5 trading days. Now the good news is that in the Treasury market, as the Fed stepped in and backstopped that, provided liquidity, started actually buying treasuries, providing capital, the Treasury market has basically completely recovered. The liquidity is back. To a very, very large degree, I would say a 90% plus degree, that's also true of the municipal bond market. The Fed has stepped in. They have backstopped it. They've actually started buying some munis on the short end. They've made it very clear that they're going to provide financing through the new municipal lending facility that they're starting, which is a new single-purpose facility. So the muni market literally went from a bull market to a bear market back to a bull market in 10 trading days. And now we're at yields that are actually slightly lower than they were at the beginning of the year. So there's plenty of bids out there. You're actually starting to see some new issues out there. And that market is largely really returned to normal, with the exception of anything that's lower quality. Lower quality is still clearly being penalized. And this would also be true in the corporate bond market. The corporate bond market are still at higher spreads when you look at option adjusted spreads for the average investment grade corporate than where it was at the beginning of the year. But general liquidity has come back to that market again at very low interest rates. The new issue market is very robust, a lot of new issues that are coming to market. And the only place that you have a problem is still in the high yield. Because in both cases, in non-investment grade, whether it's corporate or munis, there is no help coming from the Fed. And on the muni side, basically most of that help is also going to be the larger municipalities. As a matter of fact, the new municipal lending facility is not going to provide any support to municipalities. Cities have to be over 1 million in population, and counties have to be over 2 million. So if you're a smaller community or you're an agency, you're going to float this on your own. You don't have any help. Fortunately, here at RNC, we're in those bigger municipalities. We're in general obligations. We're in large revenue securities. So fortunately, the areas that we are going to be the most secure. They're going to get the support. And fortunately, pricing and trading has largely, as I mentioned, pretty well returned to normal in both those areas of the corporate and in particular in the muni side. So there's one more topic that I want to cover because we're getting a lot of questions with regards to dividends on stocks. And the vast majority of the stock portfolios that we manage and securities we use are either paying a dividend, or a lot of the assets and the majority of the equity assets that we manage are actually high dividend. Right now, those portfolios are averaging 4.5% to 5% in dividends. If you're a taxable client, you're only paying 20% tax on that. So on a pure cash flow basis, it's actually one of the most attractive investments that's out there. If the market does nothing, you're collecting 4.5%, 5% while you wait. And I think we all feel very confident that even though we may not know what the next 3 weeks is going to bring, or even the next 3 months, certainly 3 years from now, prices are going to be higher. So you've collected your high dividend, and whatever appreciation is going to accrue, during that time period, and you've been well insulated on the downside. The real question is what's going to happen to dividends. Where are we going to go? There's companies that are doing some cuts in dividends. Obviously, the areas that have been the most hit by COVID-19 are suffering cash flow squeezes. And what I think it's very important to note is that there's definitely a haves and have-nots in this current market, in this current economy. There's those that are, again, still have steady cash streams. There's those that are going to recover very quickly, and those that are going to have ongoing problems. I mean, the companies that we're focusing on are very, very large companies. They're averaging over $150 billion in capitalizations. We're looking at companies that not only are management's very committed to the dividends, but they have the liquidity on their balance sheet. They have the financing capability, that they are very, very focused on maintaining that dividend. And if we see any chinks in the armor, you've seen a lot of transactions in the portfolio. We have not hesitated to pull a trigger to move those out where we felt that there was going to be a problem. And at the same time, we've taken that money and reinvested it in areas that we think have significant opportunity and consistent dividend flow. So we're very, very focused on the integrity of that, as corporate managements are. I mean, the good thing for high dividend investors is that regardless of profitability, the overall mental focus and the mental attitude of both investors and, fortunately, board of directors right now is they look at that dividend more of almost like a coupon payment. And they look at it as being very, very close, really mentally only one small notch below paying the coupon on their bonds. They know that's why investors are there. They know that's what they're looking for. And they also know what the risks are to their stock valuations if they cut. So they're very focused on it. We're very focused on it. And so far, we're seeing that maintenance in the companies where we are. Actually, the companies that we hold right now, ironically enough, so far this year have seen a 7% increase in dividends despite the pandemic. We actually think that trend's going to continue with the companies that we're holding. But even if it drops down and only goes up 4 or 5%, to be frank, to go through this, even if you're at zero and you just maintain dividends, is going to be quite a testimony to the commitment that board of directors and corporate managements have to paying their shareholder dividends. So we think it's a very strong area now. The municipal bond area is also paying very attractive yields after tax. And if somebody's willing to stick their toe in the water, then clearly going down into the BBB and the BB corporate market with a lot of individual analysis has a lot of opportunity. So we just wanted to bring you up to date and let you know where we are. So things are stabilizing. We're very actively managing changes in both the stocks and the bond portfolios. And as always, we're here, we're working for you, and everybody here is working 100%, whether it be in the office or remotely. So please don't hesitate to contact us if you have any questions, and we're happy to really go through all the information with you personally and individually. So again, thank you for your confidence, and we're here and working full time for you. Thank you.